Hi, I'm Jim Leaviss from M&G. I'm here at the Takikawa Velodrome in Japan, just outside Tokyo. No particularly good reason why we're here, except that my greatest sporting achievement was third or fourth in the Kirin, which is what we're watching here today at Herne Hill Velodrome. I guess the fact I can't remember whether it was third or fourth probably means it was fourth. Anyway, we're here today to talk about Japanese economy in a couple of minutes. Last time I was here, core CPI was heading up towards 1%, and there were some expectations that maybe the Bank of Japan would think about hiking or at least end its QQE or yield curve control. Now, a lot of that has gone out of the window now because core CPI, excluding energy and food, has sunk all the way back down to around about 0.5% and shows really no signs of going anywhere. So it was a case we thought the central bank was unhappy with negative rates and it was unpopular with the public, but with the target at 2%, it's really difficult to see why rates go up from here, or indeed why QQE or yield curve control is significantly modified. And for that reason, the Bank of Japan's been able to reduce its buying operations greatly in the market in order to keep 10-year yields below 0.1%. Second thing to say about Japan is that growth is disappointing. We had the first negative quarter for growth in Q1 for 9 quarters. And there are some long-term headwinds for Japan as well. The consumption tax is coming in. The last 2 times that they've done a consumption tax hike in Japan has resulted in, well, some good growth to start with. Ahead of that, as people stockpiled stuff to buy, but afterwards a growth slump. There's also a bit of a global slowdown, a bit of trade wars going on, and some political risk as well. And Abe is coming up for re-election later this year with his party, and with political corruption scandals going around the education system, it's not 100% that he'll win there. His public popularity is very, very low now. So there is some good news for Japan. The real economy is doing well. Unemployment's really, really low. The Shunto wage round that we've just had produced some slightly better than last year number for wage growth, and female participation continues to go up and up and up. So fundamentally, this is not a disastrous story for Japan, but certainly some of the robust inflation expectations and growth expectations that we saw a couple of years ago have probably faded away. Finally, whilst we're here in Japan, been seeing some of the Japanese life companies, and how they invest their money is really important for global bond markets. Because yields are so low here in Japan, they've had to go into overseas bond markets in order to hit their target returns for investors. Historically, that might well have been the US Treasury market or US credit markets, but because of the hedging costs in buying US dollar assets and hedging them back to yen are really quite high, and that takes returns of US dollar assets down below those of JGBs. So instead they've looked to Europe, and they can buy OATs and bunds and hedge those returns and get some decent returns for Japanese investors. One fly in the ointment is that they've also been buying BTPs, Italian government bonds, and the sell-off that we saw in Italy about 2 weeks ago has caused a few losses in Japanese life companies. Not enough to be systemic, but something to keep an eye on. So as always, Japan proves incredibly interesting for global bond markets. This is Jim Leaviss from M&G's Bond Vigilantes team.